Most decentralized finance protocols rely on a relentless schedule of token unlocks, which constantly dilutes the circulating supply. This ongoing inflation creates a structural drag on asset prices, forcing the total supply to expand regardless of demand. Market participants have learned to view any active emission schedule with immediate skepticism. On Protocol Day 172, PLAZM is operating under an entirely different set of economic rules. The system is currently destroying its own tokens at a rate that vastly outpaces the creation of new ones. This imbalance becomes clear when we measure the daily buy and burn mechanism against the daily token releases. On the left, today's emissions represent $2.87 in new tokens. On the right, $352 is deployed to buy and burn PLAZM. The weight of the burn side causes the scale to slam downward immediately, destroying 122 times more PLAZM than is released today. A hard-coded economic engine executes this programming with deterministic precision. This level of structural deflation requires a complete reevaluation of how the token's baseline value is calculated. The token's economic reality has detached from standard inflationary models, moving from an asset that dilutes to an engine that compresses. We define the crossover as the mathematical threshold where structural deflation permanently overtakes programmed inflation. Our goal is to deconstruct the two competing mathematical engines that drive this system toward that threshold. We will analyze this economic engine through deterministic data, looking past market sentiment to the underlying mechanics. This is a theoretical look at high-risk DeFi mechanisms for educational purposes. It is not financial advice. Understanding this specific intersection provides a mental model for evaluating systemic equilibrium and true scarcity in any decentralized structure. We begin with the first force in the crossover equation, the emission schedule, which acts as the denominator. This schedule is public, predetermined, and designed to decay over time. The system enforces a fixed decay rate of negative 0.08%, compounding every single day. This chart shows the projected releases for the upcoming week. Today, on day 172, exactly 113 PLAZM tokens reach their unlock date. The 7-day average remains low, at approximately 415 tokens per day. Day 174 presents a single notable spike, where 2,575 tokens will unlock. Standard DeFi protocols typically view a spike of this scale as a significant sell pressure event. In PLAZM's current context, these 2,575 tokens carry a total market value of only $65. Following that spike, the schedule hits a sharp cliff. On days 178 and 179, new emissions drop to absolute zero. The negative 0.08% daily decay rate ensures this long-term downward trajectory. Every passing cycle reduces the amount of new supply capable of entering the open market. The denominator in our equation is a mathematically fading force. Programmed decay has rendered this inflation a mathematical ghost. Because the inflationary force is engineered to decay, it systematically starves the market of new token supply, driving the denominator toward zero. We now turn to the opposing force, the Treasury's yield generation engine. The system is backed by a vault holding over $470,000 in DexFi bonds. These are Treasury assets that generate yield through decentralized exchange fees. These bonds currently produce a consistent $542.31 in yield every 24 hours. This diagram illustrates the capital routing. The daily yield splits into 3 streams, with the majority allocated to supply reduction. The largest stream represents 65% of the daily yield, roughly $352, flowing directly into the buy and burn mechanism. This $352 goes to the open market every single day to buy PLAZM. These purchased tokens are immediately burned, removing them from the supply permanently. At current prices, this mechanism evaporates approximately 13,858 PLAZM every day. We can test the strength of this engine by comparing it back to the protocol's emission schedule. Even against the upcoming day 174 emission spike of 2,575 tokens, the daily burn is still 5.4 times larger. The baseline burn rate mathematically neutralizes even the most significant unlock days. This persistent buying pressure functions entirely through internal yield, independent of new user capital. To date, over $68,000 has been deployed through this specific mechanism. The burn engine obliterates incoming inflation, forcing even the highest emission days into net negative supply events. This relationship is expressed in AJ's theorem. On this graph, the red emission line slopes downward, while the green burn capacity line slopes upward. The intersection of these lines marks the crossover. Beyond this point, the protocol operates in a state of continuous supply contraction. The upward slope of the green line is driven by the buy and grow mechanism. Buy and grow uses 20% of the daily yield to acquire more bonds, currently adding 2.77 new bonds to the Treasury every day. Because more bonds generate more yield, the burn capacity increases. This acceleration happens independently of user adoption, making increasing scarcity a mathematical certainty. We can now examine the macro impact of these daily flows on the total PLAZM supply. Within the fixed 9.3 million token supply, 19% is already burned and permanently removed. Staked tokens account for 24%, while 16% is committed to liquidity pools. This leaves a liquid float of only 41% to determine market price. The current velocity of the burn engine creates a highly restrictive supply environment over the next 30 days. Approximately 415,000 tokens, roughly 4.5% of the total supply, will be destroyed in the next month. These inescapable physics define a system that is continuously and relentlessly compressing its own circulating supply every single day. The protocol crossed the crossover threshold weeks ago. It is now a historical fact. While the system continues to distribute yields and accumulate treasury assets, the remaining variable is the time required for market price discovery to align with this structure. By removing supply while locking up significant portions of the remainder, the protocol moves the tradable float toward a theoretical minimum, creating a deterministic supply-side shock.